SCHD or YieldMax ETFs? That is the question. Now, these are both very popular ETFs in the dividend investing community, but let's see what each of them has to offer to its investors. To start off with, we have the old reliable and SCHD, or as some investors call it, SCHD. By some investors, I mean just myself. The Schwab US Dividend Equity ETF. This is a passively managed fund that's going to track the Dow Jones US Dividend 100 Index. So nobody's going in each day and trying to place strategic, tactical moves to make more money. Instead, they're just going to be following the index. The index creates criteria and requirements to get into the fund, and then they screen out stocks that don't qualify every year during their annual reconstitution. Other than that, the only buying and selling they will do is each quarter to make sure that no stock or sector makes up too big of a percentage of the ETF. Since it's not actively managed, that allows for a super low expense ratio of just 6 basis points, so that's $6 for every $10,000 invested. This is an amazing opportunity to get exposure to 102 blue chip companies for a really low price. Trading right now for just $75 a share, that gets you exposure to all these companies. It sure is cheaper than one going out and just buying all these stocks on their own. SCHD, they filter out for high quality companies with extra emphasis on the sustainability of those dividends. That means they're going to pick stocks based on financial ratios that are among the best in the industry, and they want companies that can pay and increase dividends over long periods of time. This is a great way to get a core position going in an investor's portfolio of dividend stocks. Owning SCHD means you have ownership in high quality companies like Home Depot, Pepsi, Coca-Cola, Broadcom, and so many others. And then you also get diversification through the different sectors as well, as they try to do all that work for us. SCHD operates more like a traditional ETF. It's pretty predictable, but nevertheless, it's a very profitable ETF. YieldMax ETFs, on the other hand, are definitely not your ordinary ETF. But they have the opportunity to not just be profitable, they also have the power to potentially be one's own money printer. YieldMax ETFs are relatively new. They first launched toward the end of 2022 and have not yet even paid a full year's worth of dividends just yet. Contrast this to SCHD, which has consistently paid out dividends every quarter without interruption since their inception in 2011. Despite being called an ETF, YieldMax technically doesn't actually own anything like their underlying equities. Instead, they are synthetically owning them using a synthetic covered call strategy. This fund believes they can bring in a lot of money by selling out of the money calls. These calls are sold over a synthetic long stock position comprised of long at the money calls and short at the money puts, and by combining the long call and short put options, they can synthetically mimic the exposure of actually being long on the stock. Now, what I described is probably a little bit more confusing to understand than SCHD, which is just following an index. Investors should always know what they're investing into and fully understand all of the risk. However, investors may be turning a blind eye to those risks at the allure of those juicy yields. YieldMax does synthetic positions because it requires less capital than just flat out owning the shares, and then they buy US Treasuries for further collateral. Treasury bills are supported by the good faith of the credit of the United States government, so there's essentially next to no chance that they're going to default on these super safe assets. YieldMax can also use them as collateral for their derivative investments, plus these treasury bills are also yielding some income on the side. YieldMax has options of OARC, TSLY, Appley, NVIDIA, and these are all paying out a staggering annualized yield of 30% to nearly 70%. Imagine getting your entire investment back in potentially just 2 years. YieldMax has also launched newer ETFs which will practice the synthetic covered call strategy I described earlier on companies like Disney, Amazon, Facebook, Netflix, ExxonMobil, Microsoft, and this one should be interesting. There's also going to be an ETF now on Coinbase. Coinbase has a ridiculous beta of 2.72, which indicates the stock is expected to be significantly more volatile than the overall market. If the stock market goes up or down by 1%, you can expect Coinbase to fluctuate 2.72% instead. The reason I bring this up is because YieldMax ETFs are going to fluctuate in monthly distributions based on a number of factors. One is the implied volatility that we just talked about. The more volatile a stock is, the more those premiums are going to be super juicy. But unfortunately, volatility also has the chance to go down, and unfortunately, the dividends are going to come down when the volatility isn't there. There's also the price of the underlying equity, the distance of the out-of-moneyness, and time to expiration. All those are going to impact YieldMax distributions in the short term. While there is certainly some volatility in SCHD's quarterly dividends, the monthly dividends YieldMax will pay out are going to be quite sporadic. Because YieldMax is selling call options at 5 to 15% out of the money, that's actually going to stunt the capital appreciation of those equities in the long run. That upside being capped but having unlimited exposure to any losses means there will be very little capital appreciation for YieldMax ETFs. All those gains are going to be coming from those juicy monthly dividends. SCHD though, they don't have any of those restrictions. And that's why since their inception, the fund is up 193% in capital appreciation alone. And at times, it has even beat the S&P 500 in total return. In exchange for that upside capital appreciation potential, SCHD only has a dividend yield of 3.5%. I'm using only 3.5% in quotes because that's still an amazing yield, but comparing anything to YieldMax's ridiculous yields these days, that's not really a fair comparison. SCHD dividends will most likely be qualified dividends, while YieldMax ones are unqualified, which means they will be taxed at higher rates. So which one should you pick up, SCHD or the YieldMax ETFs? Well, that's certainly going to depend on where you are in life and your risk tolerance. Like most things in life, it doesn't have to be one or the other. Instead, we should be grateful we have so many wonderful options to help us grow our wealth these days. SCHD is a time and tested ETF that will help investors get rich slowly. YieldMax though is like that special juice you see an athlete drinking. A better metaphor might be that SCHD is the wooden sailboat we've been using to cross the ocean for decades. It's super reliable, we can sleep well each night, and by the end of the trip, we will have reached our destination safely, even if it took quite some time. YieldMax is like that sleek, new, semi-autonomous vessel with all the latest gadgets and features. It can get you across the ocean in record time, but then there's also this risk that the vessel will implode on your journey. Just remember that success slowly builds character. I've made a lot of videos that go into more detail on SCHD and YieldMax funds that you can watch right here. Alright guys, let me know what you think of these two asset classes we have the opportunity to invest in. Remember to like this video to help out a small-time YouTuber. See my full $155,000 portfolio in the link below. Thank you to all my Patreon supporters. My videos are always found in podcast form under the Collect Cash podcast name, and I'll catch you on the next one.